So you are thinking of resigning from GEPF, and one of the things that's concerning you the most, perhaps even keeping you up all night, is how do you ensure that you have enough money to last as long as you live? Or do you have enough money right now? Now, in this video, I'm looking at one of the most important elements that you must consider when planning a resignation, which is tax. And let's face it, if you don't get your tax planning done properly and thoroughly, as I'll show you inside of this video, it's one of the things that could result in you losing a fortune of money, which means the balance of the money that's left over might not be enough for you to live comfortably. But in this video, I'm sharing with you some of the secrets, and I'm also guiding you some of the mistakes that other members have made so that you can prepare yourself in advance. Now, I'm Devanaika, and I help government employees like yourself make one of their most important financial decisions, which is whether you should retire or resign from GEPF. But I also specialize in tax planning when it comes to GEPF members, as well as investing, ensuring that the capital is going to be secure, and some of the techniques that you can put in place in order to ensure that you don't run out of money. In this video, again, I'm talking to you everything that you want to know about tax. Now, let's get started. The first, I want to give you a framework, so a basic, a foundation to understand the process, right? What's the flow of money moving from GEPF into an insurance company or again into your bank account? So there are two ways in which the funds can flow. Presently, your money sits within GEPF, and you have the option, if you wanted to have that entire amount drawn out in cash. It's an option that is available to you. Now, if you draw out those funds in cash, naturally, I know the alarm bells are going off in your mind. The thing that you want to be mindful of is tax, right? Which we'll do a tax calculation now. And I'll guide you on this formula in this video, but I want you to watch the video again. But the second time around, use your GEPF statement so that you can do the calculation on your own. First thing, remember that when you're doing a calculation, you want to make sure that you're using the latest tax guide. And also when you're working with your GEPF statement, ensure that you're getting something that's very accurate, right? So the date on the GEPF statement should reflect the date when you are leaving. Let me explain with a quick share. So if you look up ahead, I've got a GEPF statement here. Now notice in the middle of this statement, this is page 1. It's got estimate of benefits as at 31 December 2018. What you want to do when you're doing your GEPF calculation is request a statement from GEPF as at the date that you want to leave, right? So if you are leaving in 6 months' time, then request a statement from them in 6 months' time. If you're leaving in a year's time, then request a statement in a year's time. And the reason that you want to do this is the value, the resignation value that's inside of your statement is more accurate at that time, right? So for example, you'll notice this member has a statement, has a value, a resignation value of 5.1 million. That's inside the pool here. But if this member is leaving in 6 months' time, the resignation value is going to increase, right? And the same applies to you. If you're leaving in 6 months' time or a few years from now, whenever you're leaving, the resignation value is going to increase. So you want to prepare yourself, and you prepare yourself by doing the accurate calculation. And again, this means you want to get that statement from GEPF in advance. Now, remember, GEPF is a defined benefit fund, so you can make this request, right, of them. What you also want to be mindful of is GEPF can adjust the formula, meaning they can change the formula here, and if they do, it affects the resignation benefit. So just keep that in mind. But the resignation benefit, if you're following the guidance I'm giving you, it should be a good estimate, right? And it helps you to get the calculation done well. So now that you know this, I'm going to use an example when I'm doing my tax calculation, just to make the math look easy for me. And again, you can follow this around the second time around, is I'm going to say that there's a 6 million Rand pool, right? Which means that the resignation benefit is 6 million Rand, and the tax calculation I'm doing for you is going to be on the 6 million Rand. Now, the first thing we're going to look at is what happens if you had to withdraw all of this money in cash, and the tax calculation will be as follows. So let me get up a tax guide for you. Again, remember, when you're doing this, you want to make sure that you're using the latest tax guide. I'm using the latest one from when I had shot this video. So on the tax table, if you are beyond age 55, which I'm assuming you are, we're going to use this tax table here. You might have heard of this, which is the retirement fund lump sum benefits. And it's a table that says the first 500,000 is tax-free. So notice it says 0% of taxable income for the first 500,000. And then as you move up the scale, so if you're taking between 500 and 700,000, it's moving higher. If you're going from 700 to 1,050,000, it's even more. And if you are taking in excess of 1,050,000, It's an even higher, it's the highest. It's at 36%. Now, when you're doing the calculation, we're going to follow this table. Notice the 6 million Rand that I'm using in my example. It's more than 500,000. It's more than 700,000. It's more than this 1,050,000, which means it's falling on the last leg here. And the last leg says the following: 130,500 plus a further 36% of whatever is more than 1,050,000, right? So watch the calculation as I go through it. You don't have to do anything, just follow along on the calculator that I'll bring up on the screen. So the resignation value in my example is 6 million Rand. SARS is saying 36% of whatever is more than 1,050,000. So the first thing I'm doing is I'm minusing 1,050,000. And the reason I'm doing this, I want to see what's more than 1,050,000. The value that's more than 1,050,000, in my example, 4,950,000, I'm multiplying that by 36% because that is the tax that SARS would take away, which means in this case, you can see just over 1.7 million. But that's not the only tax, right? If you go back onto the tax guide, we just worked one leg of the formula. So we worked this leg of the formula here. What SARS says is they want a further 130,500 from this, right? So we're heading back to the calculator. It means you've got to add 130,500 to this, which means 1,912,000. So let's go put that into the sheet so that you get the perspective of it. If you are opting, in this case, to draw cash, again, remember you use your own calculations based on your figures. So if this member opts to take out cash, the tax here is 1,912,000, which means the after-tax amount of money, see, after-tax amount of money is going to be 6 million Rand, which is what this member started with, minus the 1 million Rand, right? So we'll do the calculation together quickly. So I'm just working that difference. Again, you can follow through. So 4 million Rand. So what it means is the after-tax amount is 4,087,500 Rand. Now, this is a significant amount of money to lose in tax, right? If you look at how I've shown it to you, the total benefit that this member had is 6 million Rand, but the amount that actually got paid out after tax is going to be 4,087,000. You see, 1.9 million is lost to tax. Now, this can be detrimental, right? If you don't plan that, it can basically ensure that you're going to run out of money. It's a significant amount. It's well over a third of this money that's now, well, as you can see, it's about a third of the money that's being lost to tax. And it happens in a flash. What can you do to count it? I'm going to show that with you. Before I share it with you, I want to make sure that you don't make this mistake when you're doing the tax calculation, right? So notice when I did the calculation, I looked at the last leg of the formula. So I'll bring up the tax guide for you. I didn't start off minusing 500,000, right? So please, this is a mistake that I see often members making. You don't start off with your resignation value, then minus 500,000 and then calculate the tax on this table. It's already taken into account. So notice as you move up the ladder when it comes to tax, they're saying for the first 500,000 is already taxed at 0%. The next 200,000 from 500,000 to 700, that is taxed at 18%. Now, if you do a calculation here, 18% of 200,000. So 200,000 times 18%, that's 36,000. So if you follow this, SARS is already taking into account. See, this is why in the third leg, they start you off with 36,000. So as you move up the scale, they're already taking into account. So please do not minus your 500,000 when you are calculating your resignation value, right? Just follow along as I shared with you. Look to see in which sector your 1/3 or your cash lump sum is going to be falling into, and then you work according to that leg of the formula, right? Meaning if it's more than 1,050,000, you know you're working with this leg here. So don't have to, you can ignore the other legs, just go straight into that leg. Great. So moving back, what could you do to avoid this from a tax perspective? Now, you could transfer these funds from GEPF into an approved fund. And when you make that move, so once it's transferred to an approved fund, now please be mindful, the preservation fund is only one option, right? You want to make sure that you're looking at all available approved funds so that you know you're using the right vehicle. Notice I'm not talking about insurance companies here. I'm talking about approved funds because the approved funds are available at every single insurance company. You want to compare them, make sure you're choosing the right one, because once again, once you choose it, you can't change it. So once funds go into the approved fund, the benefit here is there's no tax. So if you look immediately, right, using the example I've just done for you, this member on 6 million Rand can save 1.9 million Rand in tax merely by making sure the money is getting transferred to an approved fund. Now, the approved fund has a cost, yes, but let me tell you, the cost is significantly cheaper, right? You can watch the video that I did on the costs, comparing costs of retirement and resignation. I'll go into that in a bit more detail, but it's significantly less than 1.9 million, right? It's if you do the calculation, you're going to see this figure, it pales in comparison. It's like maybe even 10% or less. So what you want to do is have the comparison done. It might be cheaper now. It is going to be cheaper for you to move into an approved fund as opposed to paying the tax. Now, what takes place from there? How do you get your cash lump sum? When you are moving money into the approved fund, it will split into two pools. One of the pools allows you to take up to 1/3 in cash, right? So you can withdraw up to 1/3 in cash. And then the balance of the money, which is your 2/3, this is going to be invested. And when you invest that, that's used to provide you with an income, right? So it's used to provide you with an income. That money as well is also not taxed. So here, when it's moved, there's no tax. The 1/3, however, is going to have some tax. We'll calculate the tax together using the same table, right? Now, 1/3 of 6 million, if we divide it by 3, it's 2 million Rand. I'll do the tax calculation for you. Again, we're following the same example, same tax table that we just used with the 500,000 tax-free. And you can see we're on the last leg of that formula, right? So let me run it by you quickly so you understand what I'm doing here. I first want to calculate how do I get the 1/3. So you can see there's 6 million Rand as a resignation value. We're dividing that by 3, meaning this member has up to 2 million that the member can take in cash, right? Now it's up to 2 million. It's not necessary that the member has to take 2 million. Again, when you're doing your calculation, plug in your resignation value divided by 3, and that's your figure, right? It's an up to figure. You don't have to take all of it. You could take less if you wanted to. So again, using my example, the 2 million Rand, it's more than 500,000. It's more than the 700,000. It's more than the 1,050,000, which means we're on the last leg. So last leg, as I shared with you, we're first trying to figure out what's more than 1,050,000. That would be taxed at 36%, right? And then we're going to add the 130,500. So watch the video again if you need support. In fact, I encourage it because then this is how it's going to make sense to you, right? You want to get this tax planning done in advance and you want to do this thing thoroughly. So I'm first finding out what's more than 1,050,000. So I'm minusing 1,050,000. That 950 is taxed at 36%, which means the tax is 342. But remember, we're adding that 130,500. So when we add the 130,500, it means the tax here now is going to be 472,500. So heading back onto the iPad, as I was explaining with you, notice now the difference. If you're moving money to an approved fund and you take 1/3 out, assuming again it's 1 million using this tax table, we see it's 472,500 in tax. Now compare the difference between the two, right? 1.9 million versus 472. That difference is close to 1.5 million saving on tax. Now I want you to see as you watch this video, have you signed any documents with me? No. Have you invested any money with an insurance company? No. But are you more empowered now with the information that you have? Yes. And can you see the power here is you want to get your tax planning done in advance, right? So here's the time frame. This is where you are right now. And this is when you want to resign. What most members make, most members make this mistake. They end up leaving the resignation planning right to the end because the focus is only on resignation at that point in time. The optimal time to start your resignation planning is 3 years ahead, right? That gives you time to test tax planning. It gives you time to test investments, make sure that your money is in the right place, and also give you time to test financial advisor or financial planner, right? Or in my case, a GEPF resignation specialist. You want to do that because one of the hardest things is to build trust. So you want to build trust in the tax planning, in the investment planning as well as with the GEPF specialist, so that you know that everything's going to work out well, right? So that's your optimum time, which means in order for you to create the most amount of tax saving, you have to start planning now. When you do your tax planning now, it puts you in a position that you have the best foundation when it comes to resignation, right? So resignation planning should start now, and it continues at the time that you actually leave, right? It doesn't start when you actually are resigning in the month. It starts way earlier if you want to make a success of this and if you want to be able to put yourself in a position where you get the maximum benefits. So now you know the tax secrets. You know exactly how to calculate tax if you're resigning from GEPF after age 55. A word of warning, there are multiple avenues that SARS looks at when they're doing the tax calculation. So it's always best to connect with a specialist. You can always reach out to me if you're needing guidance on how to do the tax planning, so that I can assist you on a one-on-one basis. I work with members who have 25 or more years of service, or members who have been around from before 1998. Also get an extra tax-free benefit because of the pre-98 tax. So you want to take number of factors into account, because you can see below here, STARS has some fine print, right? And that fine print also plays a huge role when you're doing the tax calculation. So what I've done for you here is the absolute basics. Use this here to get some sort of idea as to how the tax on resignation can be. If nothing else, you want to use it to put yourself in a position where you can start to see the value, right? The benefits that resignation can offer you from a tax perspective. If it's planned well, there's no reason why you cannot bring your tax to the absolute bare minimum. If it's not planned well in advance, then yes, resignation could result in you paying a fortune in tax, which cannot be recovered. So I hope you found the video helpful. Post comments below to guide me on your tax calculation. What support are you needing? What have you found helpful here? And if you are aiming at resigning, how helpful has this been in terms of you being now empowered to do the tax calculation on your own? Remember to subscribe to the video so that you're able to get the latest content as soon as we produce them. And if you have a GEPF member who needs assistance, I encourage you to share this video with them so that they're able to be empowered to do tax calculation on their own. And I shall see you on the next video.